If you're thinking about investing or have already started, I need to warn you. There are truths no one tells you that can determine whether you'll make money or lose everything. Many people enter the market thinking they'll get rich quickly, but the reality is quite different. The fear of starting, the pursuit of immediate returns, and the anxiety during crises can ruin your results. Today, I'm going to show you what really matters to build true wealth and avoid the mistakes that destroy beginner investors. If you want to protect your money and invest wisely, watch until the end. Welcome to Wisdom and Finance. Here, you'll learn how to invest wisely, manage your money, and build wealth safely. If you want to transform your financial life, make sure to subscribe to the channel and leave a like to help this content reach more people. The importance of time and the trap of quick returns. Many investors, when starting their journey, feel an inevitable regret. I should have started earlier. This thought, while understandable, can become a dangerous obstacle if not overcome. Time is one of the greatest allies of an investor, as it allows compound interest to work its magic. The earlier you start, the greater the chance of building solid wealth without taking unnecessary risks. However, instead of dwelling on the past, it's essential to focus on the present and adopt a sustainable strategy for the future. In an attempt to make up for lost time, many end up falling into the trap of high-risk investments, lured by the promise of quick gains. However, the relationship between risk and return is clear. The higher the potential profit, the greater the potential losses. This search for shortcuts can lead to impulsive decisions and jeopardize financial progress. The safest path is to invest with discipline, allocating resources to solid and diversified assets. Instead of betting everything on uncertain opportunities, it's more effective to build a consistent habit of making regular contributions. For those who started later, the best approach is not to race against time but to focus on what can be done now. Prioritizing the frequency and amount of investments is the key to sustainable growth. Even if the results are not immediate, consistency will pay off over the years. As Warren Buffett wisely said, "The best day to start investing was yesterday, but today is the second best." Regardless of age or when you begin, the most important thing is to take the first step and stay committed to the journey, ensuring a more secure and stable financial future. Overcoming the perception of not having resources. The feeling of never having extra money to invest is common. Many people believe they can only start investing once they reach a certain financial level, but this waiting game can be endless. New expenses and priorities will always arise, competing for the budget. However, those who learn to set aside a portion of their income, even if small, from an early stage develop a powerful habit that makes all the difference in the long run. The secret is not about earning more but managing what you already have more effectively. In the beginning, investing can seem discouraging because results are not immediate. Seeing small amounts invested may give the impression that the effort isn't worth it. However, this mindset ignores the power of time and financial discipline. Small, consistent contributions over the years turn into significant sums. For this to work, it's essential to resist the temptation of impulsive spending. Consumption will always seem more appealing in the short term, but those who control their momentary desires build a financially secure future. One of the most effective ways to prevent money from disappearing throughout the month is to adopt the pay yourself first strategy, popularized in the book The Richest Man in Babylon. This technique involves setting aside a portion of income for investments before covering any other expenses, ensuring a commitment to one's financial future. The government does something similar by deducting taxes directly from salaries because it knows that if it relied on individuals to do it themselves, many would fail to pay. Similarly, those who don't prioritize their investments from the start will rarely find extra money left at the end of the month. By shifting this mindset and placing investments at the top of the priority list, it becomes possible to build wealth gradually and sustainably. The importance of starting despite uncertainty. Many people postpone investing, waiting for the perfect moment. The belief that it's better to wait for economic improvement or avoid investing during turbulent times may seem prudent, but in reality, this delay can be costly. The financial market will always go through fluctuations, crises, and periods of euphoria, and trying to predict the perfect time to start is an illusion. Instead of searching for ideal conditions that may never come, it's wiser to adopt a long-term approach and begin regardless of external circumstances. Experienced investors understand that crises often hide great opportunities. However, the main focus should not be on waiting for sharp drops to buy assets at a discount, but rather on maintaining consistency. Those who make regular contributions to solid investments naturally take advantage of the best opportunities without needing to make risky predictions. The discipline of investing every month, without being swayed by temporary pessimism, is what truly builds wealth over time. The truth is that uncertainty will always be part of the game. The market will never be completely predictable, and those who wait for stability may lose precious years without building wealth. The key is to act with strategy and patience, without letting fear paralyze financial decisions. After all, those who learn to invest despite uncertainty reap the rewards in the future. The most important thing is not to time the market perfectly, but to take the first step and remain consistent over the years. Focus on an investment routine instead of speculation. The desire to find the next big opportunity in the financial market leads many investors to make mistakes. When a sector or asset experiences significant growth, it's common for a large number of people to jump on the trend, hoping to replicate past gains. This has happened with real estate funds at certain times, with Bitcoin during its peak valuations, and even with fixed income investments when interest rates were high. However, this pursuit of quick profits often leads to disappointment, as the market is cyclical and fluctuations are part of the game. The problem with chasing trends is that no one can consistently predict where the market will move. Investors who jump from one strategy to another, trying to time the perfect buy or sell moment, expose themselves to unnecessary risks and may miss out on good opportunities. Instead of speculating, the best approach is to build a disciplined investment routine. Regularly investing in solid assets, without being swayed by market emotions, leads to more stable growth over time. The real secret to investment success lies in consistency and patience. Making frequent and diversified contributions reduces the impact of market fluctuations and increases the chances of building sustainable wealth. As the saying goes, time in the market is more important than trying to time the market. By letting go of a short-term mindset and focusing on a consistent strategy, it's possible to avoid pitfalls and ensure a more secure financial future. Keeping perspective in times of crisis. Experiencing significant drops in investment value can be discouraging. Watching the wealth accumulated over the years shrink rapidly creates the impression that all the effort was in vain. When account balances decline, it's natural to feel insecure and even question whether continuing to invest was a mistake. However, downturns are part of the market cycle and should not be seen as a sign of failure. Those who understand this dynamic and remain calm can navigate turbulent periods without making rash decisions. Volatility is part of the game, and financial markets often experience sharp fluctuations. Statistics show that major downturns occur periodically, but in the long run, they tend to be overcome. The worst reaction during a crisis is to act on impulse and abandon a well-established strategy. Many investors give up when prices fall, only to see the markets recover later. Instead of focusing on temporary losses, the best approach is to stay committed to regular contributions and view the downturn as an opportunity to buy quality assets at lower prices. Just as crises can cause panic, periods of strong growth can lead to euphoria. Watching investments rise quickly can create a false sense of expertise, leading some to take unnecessary risks. However, true financial success is not measured by quick gains but by consistency over the years. Instead of hastily selling an asset that has appreciated, The best course of action is to assess its long-term growth potential. After all, the key to building sustainable wealth is not predicting short-term market movements but maintaining discipline regardless of market fluctuations. So, do you still think investing is just about putting in money and waiting to get rich? The market can be challenging, but with discipline, patience, and a well-defined strategy, you can build a solid financial future. Don't let fear or greed drive your decisions. True success comes to those who stay focused and make smart choices over time. Thank you so much for watching until the end. If this video helped you see investing in a new light, go ahead and leave a like and share it with someone who needs to hear these truths. See you in the next video with more tips for your financial freedom. Until then.